This is Dr. Duru from Ahan Analytics with the market breadth this week was about as bullish as could be, and yet there is now a bearish signal that's bugging me yet again. You all will be familiar with it if you've been following this, following my blog or the videos. It's market breadth. It flashed bearish this week is exactly the scenario I didn't want to see. I'll get into the charts very soon. Unlike the last time this bearish signal flashed, and this was ahead of the March-April sell-off, this time I'm going to be more deferential to the price action on the indices. And the price action indices are telling me just to ignore the market breadth signal for now, but it is front of mind. Now, there was some news. Earnings season has kicked off. The biggest news that seemed to disrupt any of the market's flow was a blip on Thursday, April 23rd, when there was a rumor, I guess, that Israel was invading Iran's airspace. So it sounded like there was about to be another bombing run. Turned out to be false. And the market rebounded very quickly. And the way I interpret the rebound is that this is exactly the kind of thing we can continue to expect, is that sell-offs that happen because of war news will lead to higher prices. Why is that? Is because each incremental piece of bad news is going to wash out and take out sellers, and the ratio of buyers to sellers is going to get bigger and bigger and bigger, and that's going to help pressure the market up. That's the theory I'm working with until this bearish signal from market breadth plays out. All right, let's just go ahead and dive right into the charts right now. This is my favorite technical indicator, the percentage of stocks trading above their 50-day moving averages, what I like to call AT54, above the 50. This is the chart that's worrying me. You all might recall way back here in January, AT50 made this double top right at the overbought threshold, which is 70%. That's 70% of stocks trading above their 50-day moving averages. And it failed once, failed twice. And all along the way, I was saying this was bearish, bearish, bearish setup. But only the NASDAQ really was confirming the bearishness of this signal. Now, fast forward to today, and look at this. We have almost a repeat here. Let me just zoom in. And you can see here, this is a big failure from the overbought threshold. And AT50, just like the last time, never closed above that threshold. This is bearish according to my AT50 trading rules. The follow through confirmed the bearishness. So even this little blip today, April 24th on Friday, did not reverse or invalidate the bearish signal. In fact, the only thing that will invalidate it is for AT50 to close above the overbought threshold. And yet, I am not flipping bearish. And as soon as I take a look at the other measure of market breadth, I can explain to you why I am not yet ready to get bearish. Well, this is AT200, the percentage of stocks trading above their 200-day moving averages, what I like to call, of course, AT200. And to me, AT200 is confirming the bearish implications of AT50. Look at this. It was down for the week. Sorry, it filled the gap from, actually, this gap up was from last Friday. And if you recall, that was the big excitement about negotiations, I believe, in the war. And now AT200 has completely reversed that gap down for the week. It's confirming the short-term bearishness. So long-term market breadth is looking more bearish. I'm also worried that AT200 never recovered back to the previous highs, even though the market is at all-time highs. This is that little zone here, this purple box. This was the zone that AT200 broke out of that confirmed the bullishness. So what I don't want to see is AT200 get back into this zone. All right, so that's market breadth. Market breadth has nothing but bad news for us. And yet, let's just dive into the indices here. The S&P 500, all-time high. Let me just move this arrow over. You can see it, right? All-time high. Pretty amazing. Let me get out my, oops, not that one. Let's get this up. Okay. So you see this all-time high in the S&P 500, and that's a bullish breakout right there. If I were, say, trying to swing trade this, I would have bought this breakout to a new all-time high and just have a stop below the day's low. Simple as that. I mean, it doesn't get any simpler or easier than that. So S&P 500, no doubts bullish. It's cooled off a little bit. The week was choppy, so that, it was very short consolidation for this overheated move that brought us into trading last week. But this is bullish, plain and simple. Same thing for the NASDAQ. If I look at the NASDAQ here, similar. In fact, the NASDAQ never really cooled off all week, right? I mean, yes, it was choppy, but it was trending up the entire week. And that, to me, speaks volumes as well. Let me just go ahead and make sure you can see what I'm talking about. You see that uptrend? It just trended up. Despite the chop, it was trending up the whole time. And this, again, would be an easier trade, right? Here, you would buy the breakout. Actually, the NASDAQ would have been tricky for the trade I was just talking about. It was so easy. You'd buy the breakout here, and then you might get stopped out right there. But if you wait until the close of the day, then you probably were holding on to your breakout move. And then again here, you buy the breakout and then have a stop on a close below the intraday low. This is, again, for just short-term trading. That's how I would have played it if I were doing that kind of trade. Now, IWM is kind of the holdout now. So now the roles have switched. Remember, IWM was the clear bullish index, and now it's gone back into the passenger seat with the S&P 500 and NASDAQ following. The IWM failed to close the week at a new all-time high. It's still in its consolidation phase and still churning. And I was half successful with my call option trade. I won't go through them here, but if you've been watching these videos, you kind of know the routine that I'm in. I'm going into the coming week with a vertical calendar call spread, I think at the 280 to 285 range. All right, let's look at the VIX, because the VIX, of course, is confirming the ongoing bullishness. Now, despite the bearishness of market breadth, VIX is still bullish. It's below the 20 level, which marks elevated volatility, and it's just chopping around. If the VIX just chops around for weeks, months on end around here, we're all good. And of course, if you want to get really bullish on the market, you want the VIX to just continue to drift downwards and get below this notorious horizontal purple line here, which represents where the VIX was right before last year's big tariff drama and noise, when all craziness broke out. All right, let's go into the individual stocks that caught my interest. The big highlight for the week has to be Intel for me. Ticker symbol INTC, up 23.6% post earnings. That's absolutely amazing. Again, let me just make sure you see what I'm talking about. Here is the big move, the big pop right there. Well, I mean, what can I say? This is an all-time high actually for Intel. So it's finally recovered all of its losses from the dot-com bust. And the dot-com bust, that was back in the year 2000. So now Intel is pretty amazing. And I rarely have regrets about anything, but I'm really regretting I just didn't stick to this. But I'm just blown away by the abrupt change in sentiment on Intel. Now people are treating it like a hot semiconductor stock. And if that continues, Intel could get up to 100 in rapid order. Who knows? Because valuation doesn't seem to matter for Intel. So it's grabbing on to the coattails of animal spirits and strong market sentiment. I'm just pulling back here so you can see where Intel has come from. All these stair steps to get here. I've been following it the whole way. Intel was actually one of my contrarian plays for the year. And I won't go through all the trials and tribulations of this trade. I did profit along the way, but obviously I did not profit nearly as much as I should have. And I guess there's a moral victory to be had that I called it right at the beginning of the year. And I hope some of my readers and viewers caught this and stayed with it. All right. And the amazing thing about Intel is Intel created such a stir that it pushed up all sorts of semiconductor stocks, even AMD, ticker symbol AMD, Advanced Micro Devices, gained 13.9%. I don't even know the last time AMD benefited from a big Intel gain or loss. So Intel is now the big momentum driver, and it's because of some of the stuff they said. Intel is basically talking about a lot of capacity constraints in the semiconductor chip market. And so it means that there is going to be a scramble for chips that's going to last who knows how long. And this is all related to AI, of course, artificial intelligence. So I happen to do so. The breakout to all-time highs trade I just talked about for the indices. Well, I did do it for AMD because after it broke out above its double top all-time high and invalidated the bearishness, I put AMD on alert. And I was hoping that it would fall back to this line of support. Let me just zoom in here. I was hoping it would fall back to the line of support where I could buy it again, and it just didn't. So all I could do was then buy it on the breakout. And this was the breakout to an all-time high, closing all-time high. And I think I bought the stock right around in here somewhere. And I was basically, this is just classic chasing, but it was disciplined chasing because I'm buying at a defined point and I had a defined stop, which would be the reversal of the breakout. And obviously that reversal never happened. Now I have to be disciplined again because, look at this. AMD is so overextended at this point. And, let me just draw an animation here for you just to make the point even clearer, is that it's starting to get this parabolic curve right here at the top part. And I don't like that. And we all should know by now that at the other end, we don't know when it's going to end, but at the other end of a parabolic move is a swift and abrupt sell-off. And I'll have a classic example of that coming up towards the end of this video. So stay tuned for that. Anyway, AMD was up 13.9%. Riding the coattails of Intel, I went ahead and took profits, and I'm not going to have any regrets about that, even though I remain as bullish as ever on AMD. I just wish that the stock hadn't pushed me out of my initial position. Again, I had a very strict rule that I followed, and then AMD just, again, I wrote about this. I'm not going to go through it all in this video, but it just churned and chopped a lot, and it looked like the next move could be down below the 200-day moving average, but this is just such beautiful support that AMD was able to hold. But pretty good. And then let's just sum this up looking at the VanEck Semiconductor ETF, ticker symbol SMH. Again, just straight up, right, from the bottom, that marked the market celebration of the coming end of the war or end of the conflict in Iran. And SMH has been up and up every single day except for this one little blip. And I can't even call it overheated yet because it did pull away from the upper Bollinger Band, which is this black line that defines 95% of the price volatility. And but it was able to continue higher. And so it is not even in the technical overheated category, even though I think this run up has just been, it's just a lot and it needs a rest. So anyway, it's amazing that Intel is now a semiconductor leader and it's able to push the entire sector up. All right, let's go into some retail, starting with AMD. This is another one that surprised me. I had Amazon. I bought it around here. I sold it on the breakout, thinking that it would just churn and chop around its the previous all-time high. And yet momentum has been with Amazon. You could see here that it is at a new closing all-time high and looking as good as ever because of it, right? This is a nice breakout here. Boom. I don't know how I'm going to trade this. Let's see what happens with the earnings. Remember my Amazon post-earnings trading rules that no matter what happens to Amazon after reporting earnings, 2 weeks later, it's going to be higher. And I just stick with that rule. Over time, it has worked. Sometimes very well, sometimes disastrously, but I just stick with that rule if I'm going to trade it at all. Nike. I am finally bullish on Nike, but not because of the technicals. Technicals are still as awful as can be, but because we had a bunch of insiders jump in, and you can see the market's already testing. The technicals are already testing buyers' appetite for Nike. The CEO last week and Director Tim Cook and I believe some other insiders bought up shares, and the stock popped out of this this consolidation window. So this is a bullish breakout, but you can see just how bearish Nike continues to be on the technicals. This is the 20-day moving average, this black line here, and all Nike did was run into that and could not break out. So this downtrend is still in effect. What I next need to see is Nike hold the top of this box as support. If it doesn't, and particularly if it breaks to a new multi-year low, in fact, I think it would be like a 13, 14-year low, then I have to seriously wonder. In fact, I might just get out the stock and just wait for the next breakout, which would have to be above this level, above the 20-day moving average and this last peak. But right now, I don't expect that, but things can be tricky. People don't seem to believe the insiders as much as they used to in terms of their buying behavior. And now another thing that's concerning me on the retail side is the discount stores. Dollar General, ticker symbol DG. I do hold this, and I bought it as a play on holding 200-day moving average support. It's been doing that sloppily, sure, but it's just kind of weird that it's almost, in fact, it pretty much reversed its entire breakout from earlier. This was the breakout point right around here from the previous peak. And you can see Dollar General is struggling to hold that as support. I'm on pins and needles. If Dollar General breaks below the low here, then I'm just going to have to bail and stop out of my position. Dollar Tree, did not get back into it because it did not hold 200-day moving average support, and it is in bearish territory. In fact, looking at these two charts is suggesting to me that a pairs trade might be in order. Go long Dollar General, short Dollar Tree. So I haven't thought through it yet. It's just occurred to me looking at these charts, but stay tuned on that. And in fact, as I'm looking at this chart, let's also take a look at the bearish topping action in Dollar Tree. I just noticed it's got a head and shoulders top here. Here's the left shoulder. Bear with me as I do this. There's the left shoulder. Here is the right shoulder. And here is the head, right? And then I'm going to just draw a neckline, a very rough neckline here, just to show the approximate breakdown point. And of course, I was not watching Dollar Tree or Dollar General for a bearish trade, but here's the breakdown point. So Dollar Tree, ticker symbol DLTR, can't even get bullish again until at least breaking out above this converged 50-day moving average, 200-day moving average resistance, the red and the blue line, but it's also got to get above the previous neckline of the head and shoulders top in the stock. All right, so those are the retail. Discount retail is kind of concerning me, particularly given the enthusiasm people had in these stocks late in 2025 and somewhat in early 2026. And then Best Buy, there's another retailer. This was interesting. I wrote about this trade. Goldman Sachs issued a sell rating right at the bottom. I guess they really technically issued it before the market. And then it caused Best Buy to drop to, I think it was to a low that was challenged the lows of 2025. But then buyers, for whatever reason, decided to just take this straight up. Broke out above the 50-day moving average. I actually bought a put expecting the 50-day moving average to hold as resistance because I just thought of this buying as just being sort of this reactionary, contrary move against Goldman's sell rating, but it kept on going higher. And then lo and behold, they changed the CEO and sellers returned, and the stock dropped 4.6% on that news. It followed through 3.2%. That's when I took profits on my put option, and it's fallen another 1.7%. This is very dangerous for the stock because, Goldman issued the sell rating not expecting this move. They expected something, of course, much lower. And who knows how much lower Best Buy can go, but you can see it's just been chopping around for so many years. It's just not a stock that's truly investable. This has now become just a trading stock. All right. ticker symbol IGV, iShares expanded tech software sector ETF. I've written plenty about the software stocks. I'm just going to talk about the technicals. IGV continues to make a convincing bottoming move. It did get hammered on earnings from, I think, IBM and ServiceNow, disappointed investors, and just the entire software sector just took it on the chin. IGV plummeted 5.8% on Thursday, but check this out. This is why I love the technicals. I'm zooming in here so you can see this plain and clearly. Check this out. right at the very intraday low for IGV, stopped on a dime at 50-day moving average support. And the next day, we've got this gap higher and a 1.9, let's just call it 2.0% gain. So this is very constructive considering the bottoming action that IGV put in earlier. I did not trade IGV here because I now have enough individual software names that I don't feel compelled to rush into any kind of short-term trade for IGV. But I consider this to be very encouraging and very bullish for the set of software holdings that I have. And on my blog, I'll be covering more of those individual holdings and the Paros analytical framework that I'm now applying to software stocks. Another software stock that's actually making some moves, Manhattan Associates, ticker symbol MANH. It had a decent up day post earnings, gained 5.9%. Sellers on, again, the big sell off for software took MANH right back down to the 50-day moving average. If I had been paying attention then, I probably would have tried to buy here as buyers recovered the stock above the 50-day moving average support. And now look, it's up 2.9%. So I definitely have this on my buy list for next week. There's a little bit more studying I want to do on Manhattan Associates, just because it peaked and completely collapsed. What was this? This was back in the beginning of last year. It collapsed 24% post earnings. So I just want to make sure I understand what those issues were, because that I don't think has anything to do with the SaaS apocalypse from the AI panic. All right, and then finally, Zoom, ticker symbol ZM, Zoom Communications, sorry. I was fortunate enough to not be in the stock when it collapsed post earnings in February, but then I did buy up because I saw this bottoming action. Again, let me just draw something here for you so you can kind of see what I'm talking about. No, I don't want you. What do I want? I want a rectangle. There you go, rectangle. This is again, just approximate, but look at this rectangle around Zoom after the post earnings collapse, and it collapsed 11.6%. It immediately rebounded down here, and once Zoom broke out above this box, it became bullish as a bottoming play, even though it still had to contend with serious resistance from its 50-day moving average and 200-day moving averages. I bought it inside the box that I really liked. This might be kind of hard to see. I really like this up candle that it put on right after the big collapse. Let me just point it out to you here. It's that big up candle right there. And I bought it somewhere either in here or, sorry, the next day, and I just wrote it. Now, I was trying to hold it for longer. I didn't like this little churning action right at the previous peak, so I went ahead and just took profits. But as always, I'm keeping an eye on Zoom, ticker symbol ZM. Intuitive Surgical, I've written about this one. I have a long-term position in this. This is ticker symbol ISRG. Very disappointed that the stock broke out and came back down. But I was relieved to see it gained, what was this, 7.2% on earnings. I'll just show you again where that happened. That's this candle here, and got this minor breakout above the 50-day moving average. It hasn't been above that since the beginning of the year. So hopefully this is the beginning of a recovery and a very, very constructive move for Intuitive Surgical. Now, also on the healthcare tip, this is Tempus AI, ticker symbol TEM. They are in healthcare AI. They caught my eye on this huge move, 13.9% breakout above the 50-day moving average, very bullish. It stalled and then it came back down. So I just kept an eye on it because, I don't like chasing these kinds of breakouts. And actually, the stock never did quite follow through. You might call this day a follow through, but it wasn't really convincing enough. But now I'm itching to buy it because it's right. Look at how it held 50-day moving average support twice. Very constructive. And now the 20-day moving average, this dashed line, is moving upwards. So we're getting this sort of gradual shift in sentiment. Now, note, I have to pull this back. Note that Tempus AI is essentially over time, since its IPO, since its debut, has overall just been a very choppy stock, something you buy on dips and then sell on rallies. I don't know whether this will be another case like that, but it looks like it's starting to develop that, particularly if these support levels hold. So that's on my shopping list. TEM is officially on my shopping list. Now, let's go to some industrials. GE, GE Aerospace, ticker symbol GE, kind of worrying me. It's been spending a lot of time below the 200-day moving average, bearish, bullish, and now bearish again. Investors, traders took it down 5.6% post earnings. So GE is actually in a bearish position. This is strange because I'm very bullish on the industrial sector, but GE is really sticking out. And now this could have been the other highlight of the week, or the even bigger highlight of the week, which is Avis Budget Group, ticker symbol CAR. Like I promised, this to me is now the epic classic chart I will always show about the dangers of parabolic moves. And maybe some people look at this as the opportunity, even either on the bearish or the bullish side. I took a note. Swing Trade Bot is the stock scanning tool that I really like, and I'm a subscriber. I looked through its scans to see when did it first notice the parabolic rise in CAR. And you can see here that it noticed it. This was actually pretty crazy already. It rallied from nearly straight up from 100 to 210. Okay, it doubled in, what was that, about, let's just call it 2 weeks, maybe 2.5 trading weeks. So to flag the parabolic rise, this is actually pretty tolerant. And this was, but this was early in the overall run, right? So this is a reminder that you can't just, if you're trying to fade a parabolic move, you can't just move right in, because the move, who knows how long it's going to last. All you know is that when it ends, it's going to end ugly. And man, did CAR end ugly. It dropped when the mania and the hysteria finally ended. It dropped 38% on what was this, on Wednesday, after a gap up higher, and then it created a bearish engulfing. You can't get more bearish than this kind of chart or candle at the end of a run like this. And of course, the follow through was even more vicious. 48% the next day, gap down, pretty much just buyers have completely evaporated, completely abandoned the building here. And then another follow through to 11% loss here. Now, I'm going to spend just a little bit of time on this because there's a lot of interesting features here. And I also want to show where I traded and why I traded in this one. First of all, let's look at the 15-minute chart, because this was very telling to me when I was reviewing the chart. Maybe a little hard to see, but even at the 15-minute level during the maniac rise earlier, it was almost all upticks the entire time. There were some brief periods of chop and churn where sellers showed up, but there was pretty much this mechanical, almost all algorithmic buying. Just someone had a buying machine just constantly churning on CAR, on Avis Budget Group. Now, when I got interested, I did get stopped out earlier in this run up, and that was a good move, good stop loss move. But I kept an eye on this, and there was something that popped up here, because again, I'm looking at this mechanical buying, and I wanted to see when it ended as a signal for jumping in. And I actually moved in. I had a discipline rule. After the stock broke this 20-day moving average, I faded it around, I think it was 603, 610, something like that, on a rebound, because I wanted to short into an uptick. And yet that algorithm, that buying machine, had one more gallon of gas in it, and it took that stock up all the way to 850 or something, 840. It was a good thing that I only had a very small position here. So I was able to withstand this vicious blow. And this is what I mean by buyers evacuated the building. Look at this. Again, remember, this is an intraday chart, 15 minutes. We've gone from a case where it's almost all upticks to almost no upticks, just constant vicious selling all the way down. And now another feature I want to show you. Oh, sorry, I covered a little early. I actually had a put spread as well that I bought at the same time. I took profits early on the put spread. I took profits. Actually, looking back with hindsight, it was early, but I'm totally satisfied with it because, again, I just followed my rules. I think I covered around 365 or so. That was plenty. Now, last technical thing I want you to show, and this is why I think that what's going on here is like battle bots on the buying and the selling side. The technicals are just too conveniently neat. Look at how the selling finally slowed down. See this purple line right here? Just remember this purple line at 208.80. Selling went almost straight down. There was some buying above it. Sellers took the stock down again, and then the buyers showed up again. Sellers took it back down to this line. The buyers showed up again, but they didn't show up with quite as much force as before. And now Avis, ticker symbol CAR, closed the week right below this purple line. And why is this purple line important and of note? Let's go back to the daily chart. It turns out that this was the previous peak in CAR. All right, this was the previous peak, closing peak back here last summer in July. That was at the end of another crazy run. I mean, well, this run doesn't even look crazy anymore relative to this one. And so the technicals were in full effect. This previous all-time high didn't have much of an effect, but it was a signal for buyers on the way up. They bought on this breakout, and it was a symbol, it was a sign for the sellers on the way down when it got broken to the downside. All right, well, lots of lessons here for CAR. Fundamentally, this company is not doing well, heavily indebted. The valuation's not so bad, but I think if you account for the debt, it's a pretty expensive stock still at this point. But I'm not making any predictions. The stock is completely detached and unmoored from the fundamentals. Fundamentals have almost no impact here. There's some really big institutional buyers that are holding stock. Who knows? Maybe they finally decided to sell some, and that's what triggered this mechanical selling. Who knows? I just look at the technicals here. And if it weren't for the crazy mania before that, I would say that this stock would be a short down to at least the 50-day moving average, down to the 200-day moving average, and then definitely on the breakdown, it's a short. It's in bearish territory. Ironically, technically, it's still in bullish territory because it's above the 50-day moving average. All that to say, I'm not touching this stock again. This thing needs to cool off big time before I can make a good risk-reward assessment, either on the upside or the downside. Oh, and just as a quick reminder, I did write an article on Avis and Hertz. And this reminder, right? So for anyone who's watching earnings next week, just a reminder, Avis gave some very bearish commentary about the business. Of course, it was related to the government shutdown, but we had another TSA disruption last month, I guess it was. And I'm not sure what the condition of the airports are now. And there was this theme that Hertz started to claim that the TSA disruptions were helping the business. I am going to be so eager to see whether either company actually benefited enough to make a material difference to revenues and particularly to profits. All right. Sorry, I had to spend a little bit of time on that one. There's some important technical lessons here for both bears and bulls on this story, or bears and bulls whenever you're confronting parabolic run-ups. There's both opportunity on the upside, if you're that kind of aggressive YOLO kind of person. And then there's, of course, very lucrative opportunities on the downside, but you have to be very careful, pick your spots, and be very disciplined on the technicals for that. All right, let's go to something much more calm and sedate. Home builders. This is DR Horton, ticker symbol DHI. I earlier called an end, I think last month I called an end to the seasonal trade on home builders. As a reminder, it's a call on home builders outperforming the S&P 500 from around October to say April or May, kind of squishy on the endpoint. I called an end to it early just because of the way that the housing data was playing out and the technicals. But I didn't sell any of my holdings. I just called an end to the trade, recognizing that the home builders were not going to outperform. So that part was correct. Even with this rebound, home builders are still underperforming the S&P 500 with its all-time highs. But I'm glad I didn't sell any of my holdings. DR Horton was one of them, ticker symbol DHI. It had a surprisingly amazing earnings report, 5.8% gain. That was enough because I bought it down here. Actually, no, I think I bought it around, don't quote me on this, but I think I bought it around 200-day moving average support. Maybe I bought it down here right before I made the call for the end of the seasonal trade. But regardless, this was a clear sell signal, take profit signal, because let me just go back here. You can see DHI has just been really choppy. It traded right up to a previous congestion zone. And sure enough, just like clockwork, the sellers faded the stock and the sellers are still taking the stock down. I'll be keeping an eye on it because if the DHI is just going to chop around, I'm definitely game to buy on in the low parts and then sell at the high parts. And finally, let's end off with Lucid, ticker symbol Lucid Group, ticker symbol LCID. What can I say? I mean, this trading is just totally worrying me. Just as a quick review, I'm a big fan of the cars. I want to buy one when I grow up. And I was trying to be just as bullish on the stock, but I mean, you can see, right? It was very painful to hold this stock for as long as I did, just a constant downtrend. The final signal for me was when the company finally announced a reverse split, a 110 reverse split, and I split. I got out of the stock because I know what that means. This means when companies start to reverse split their stock, it means that their finances are in trouble and they're struggling to stay as a listed company. I look silly dumping my stock because the market, like it likes to do, did a contrary move, took Lucid, what was this, from 15, let's just call it 15 and a half, all the way back up to 24 and a half. But the technicals took over from there. Lucid did break out above the 50-day moving average, but it couldn't break out above the 200-day moving average resistance, and it's been just selling off ever since. Now, this is a resumption of the previous downtrend, so that part doesn't surprise me. What's worrying me is that I think in the middle of the week, Uber announced a partnership with Lucid. That didn't have any impact on the stock. Look at how this volume has just picked up over the last, let's just call this last 8 to 9 days. Just huge selling volume and accelerated price action to the downside. Something's not right. Maybe I missed it. I didn't see any specific news to explain this, but I am bracing myself. I'm really hoping this company stays afloat because, like I said, I like the cars, but the electrical vehicle business has just been very tough. There are very few survivors at this point. There was a period when we had all sorts of stocks and companies in this space, and they just have been whittled and whittled and whittled down. So anyway, that's Lucid. Hope they hang in there. I hope you hang in there. Stay safe. As always, I appreciate you watching these videos. Any feedback or comments, leave them down below. Please share and like this content as it helps the algorithms know what's up. Subscribe to the channel if you haven't already. All right, this is Dr. Dewar from AHAN Analytics signing out, and you all have a good one, and I will see you the next week.